The card in your wallet was built with a quiet plan inside it. The thing that feels most responsible, paying it back slowly, a little each month, is the exact thing it was designed to make you do. And that slow payment is how it keeps you in debt. It sits in your pocket right now, a small piece of plastic, no thicker than a coin. You tap it, you swipe it, and you forget about it before you even reach the door. It looks harmless. It looks like a favor someone did for you. But this little rectangle was not an accident. It was designed carefully, with a quiet plan built into its edges. Here is the strange part. The way most people use it, the way that feels careful, grown-up, safe, is to pay back a little each month. That slow, sensible repayment feels like the responsible choice. But that careful choice is the exact thing the card was built to make you do. The slow payment is not the safe path around the trap. It is the trap. By the end of this story, you will see the machinery underneath the plastic. You will see how it turns your patience into someone else's profit. And you will see the one choice, made once a month, that flips the whole thing. There are two ways a card can work. One charges you nothing when you pay the full amount. The other charges you for waiting. That single line pay in full decides which machine you are feeding. But to understand the plan, we have to go back to a time before any of this existed, before the swipe, before the tap. Back when money meant one of three things: cash in your hand, a paper check, or an account at a single store. That store account was useless the moment you walked next door. It worked at one place and one place only. Nothing you carried moved smoothly from shop to shop. And then, one evening, a man reached for his wallet and found it wasn't there. That forgotten wallet would change everything. The year is 1949, and the place is New York. Inside a restaurant called Major's Cabin Grill, a man named Frank McNamara pulls back his chair to sit with a table of business clients he very much wants to impress. The evening goes well. The food is good, the talk is easy, and then the bill arrives on its little tray, face down, the way it always does. Frank reaches for his wallet. His hand finds nothing. He checks the other pocket, then remembers he had changed suits earlier, and the wallet is still in the other jacket, hanging at home. Picture the slow, cold horror of it. He cannot pay. Not in front of the very people he came here to impress. There is no card, no note, nothing in his pockets that will settle this table. There is only one way out. He telephones home, and his wife comes across the city to the restaurant to pay the bill herself. The humiliation is complete. But somewhere in that miserable moment, an idea takes shape at the table. Frank keeps turning it over. Why should an honest man ever be stuck like this again? What if a single card could be shown at many restaurants, not just one? You sign at each place, eat, and walk out. Then, once a month, one bill arrives for everything. Sign now, pay later. Inside a trusted circle of people the business believes will be good for it. It was a simple idea. But a simple idea is not a business. To make it real, Frank needed two things he did not yet have: money to fund it, and restaurants willing to say yes. On the 8th of February, 1950, Frank McNamara and a small group made it real. They pooled together $1.5 million and gave the idea a name: Diners Club. The first card that carried this radical promise was not the shiny rectangle you know now. It was cardboard, a thin, humble sheet you could bend between two fingers. The rule printed on it was strict and simple. Sign now, then pay the whole amount when the month ended. No leftover balance, nothing carried forward, nothing owed for waiting. So, where did the money come from? Not from the diner. Note: Diners Club took a fee of about 5 to 7% from the restaurant on every meal. The merchant paid for the privilege of getting new customers. And it caught fire. By the end of that first year, about 2,000 members carried the cardboard card in their pockets across New York. 2 years later, the number had jumped to about 4,200. a forgotten wallet, had grown into a movement of paying with a signature instead of cash. But hidden inside this success was a ceiling. Because members always paid in full, the company earned only from those merchant fees. It never earned a single cent from anyone's debt. That limit was invisible to Frank, but not to everyone. Somewhere, watching this idea grow, sat the people who would soon smash that ceiling wide open: the banks. The men who ran the banks watched Diners Club grow and saw something that made them lean forward. There was money sitting there, untouched, and one company had already proven people wanted this. In 1958, Bank of America decided to take it with a plan that would be against the law today. Their target was a single city, Fresno, California. The bank did not send out forms to fill in, and it did not ask anyone to apply. Instead, it printed thousands of real, working credit cards and dropped them into the mail. Picture an ordinary family at the kitchen counter, opening an envelope over morning coffee. Inside, no letter to sign, just a live card, ready to spend the moment it touched their fingers. It happened across the whole city at once. On the same week, in house after house, spending power simply landed in people's hands. History would remember it by a simple name: the Fresno Drop. But the truly new thing was not the mailing trick. It was one small rule printed on the terms, a rule Diners Club never allowed. When the bill came, you did not have to pay the whole amount. That single choice introduced two new words into everyday life. First, the minimum payment, the small slice you were allowed to pay instead of the full bill. Pay it, and you were considered in good standing. The second word was the revolving balance, the leftover you did not pay, quietly carried forward into next month. It rolled from one statement to the next, never quite gone. And on that leftover, the bank did something Diners Club never did: it charged interest. In that moment, the card stopped being only a way to pay. It became a way to lend. This little card would one day grow into the giant we now call Visa. Picture the number on your statement. You owe $5,000. Down at the bottom, in small print, sits the minimum payment. Just $100. Next to that huge balance, paying it feels like the safe, grown-up thing to do. But look at where that $100 really goes. A large part of it is interest, the plain fee for borrowing the bank's money. Only a thin sliver reaches the actual thing you owe. The balance barely moves. Now, run the clock forward. Pay only that minimum each month, and a debt of a few $1,000s can take many years to clear. By the end, the interest you paid can add up to nearly as much as you first borrowed. Here is the part almost no one is told. The banks quietly sort you into two groups. The people who pay in full each month earn the bank almost nothing. And the second group, the people who carry a leftover and pay interest month after month after month to the bank. Those customers are the most profitable of all. Not a burden, a gold mine. So look again at that word, minimum. It was never a kindness. It is set low on purpose, low enough that you can always manage it, which is exactly what keeps you paying interest for as long as possible. And that is the quiet turn behind the little rectangle. If you carry a balance and pay only the minimum, you are not using the system. You are the product it was built to sell. So here is the way out, and it is almost boringly simple. Pay the full amount every single month, and in most cases, you pay no interest at all. 0. The clock never even starts. 2. And you lose nothing by doing it. You still keep the rewards. You still keep the protection when a payment goes wrong or someone steals your number. You get everything the card offers, and you hand the bank almost none of your money. And that, strangely, is exactly what Frank McNamara pictured that night at the dinner table. Not a trap. A short, free loan, a way to eat now and settle at the end of the month with nothing left over. The card was never meant to be a debt you carry for years. That first idea is still available to you. It is just not the one the banks make money from. So, here you are again. The same small rectangle back in your wallet, tapped at a counter without a single thought. Bank, tap. Only now, when you look at it, you can see the whole plan built into it. The whole story fits in one breath. It was born from a forgotten wallet at a New York dinner table when one embarrassed man imagined a better way to pay. It spread through white envelopes dropped into the mailboxes of one California city, live cards raining onto families who never asked. And it lasted, quietly, because the small payment always felt safe. And it all comes down to one line at the bottom of a page, one decision, once a month. Pay it all, or pay just enough. That is the whole story. That is the choice. End quote. The card was born from a man forgetting his wallet, and it grew through envelopes of free credit raining down on one California city. If you enjoyed this story, subscribe. There is always another one worth telling.